Welcome back. If you made it through Module 1 without falling asleep or having an existential crisis about your credit score, congratulations, you're already ahead of most people. Now we're diving into the world of mortgages, which is basically where banks agree to lend you an absurd amount of money based on the promise that you'll pay them back over the next 3 decades. Think of this module as your mortgage decoder ring. By the time we're done, you'll understand the difference between FHA and conventional loans better than most bank employees. You'll know exactly how much you need for a down payment without having to sell a kidney, and you'll finally understand what PMI is and why it's not actually a fancy insurance plan for your pet. This is where the rubber meets the road, folks. This is where we turn your homeownership dreams from someday maybe to here's exactly how we make this happen. So grab your favorite caffeinated beverage because we're about to decode the mortgage matrix. Types of mortgages and requirements. Let's start with the beautiful alphabet soup of mortgage types. We've got conventional loans, FHA loans, VA loans, USDA loans, and probably some other acronyms that sound like government agencies from a spy movie. First up, conventional loans. These are like the vanilla ice cream of mortgages, not because they're boring, but because they're the standard that everything else gets compared to. These are loans that aren't backed by the government, which means the bank is taking all the risk themselves. As you might imagine, this makes them a little pickier about who they lend to. For a conventional loan, you typically need a credit score of at least 620, though some lenders want to see 640 or higher. You'll need to put down at least 3%, but here's the catch. If you put down less than 20%, you'll pay private mortgage insurance, which we'll talk about later. It's like a penalty fee for not having enough money up front, which feels a bit like being charged extra for being broke. The good news about conventional loans is they often have the best interest rates if you have good credit. And there are no weird restrictions about what kind of house you can buy. You want to buy a house shaped like a boot? Conventional loans don't care. You want to buy a former church and turn it into your home? Conventional loan is here for your architectural dreams. Next, we have FHA loans, which stands for Federal Housing Administration. These loans are like the friendly neighbor of the mortgage world. They're government-backed, which means they're more willing to work with people who don't have perfect credit or huge down payments. FHA loans only require a credit score of 580, and in some cases even lower if you have other compensating factors. You can put down as little as 3.5%, which makes them super popular with first-time buyers. It's like the difference between the exclusive nightclub that requires a VIP pass and the dive bar that just asks that you wear shoes. But FHA loans come with some quirks. The house has to meet certain condition standards, which means if you fall in love with a fixer-upper that needs a new roof and has questionable electrical work, FHA might not be your friend. They're also pickier about appraisals because they don't want to lend money on a house that's going to fall down next week. You'll also pay something called Mortgage Insurance Premium, or MIP, which is FHA's version of PMI. The difference is, with FHA loans, you might pay this insurance for the entire life of the loan, even after you build up 20% equity. It's like the gym membership that you can never quite cancel. Now, let's talk about VA loans, which are available to veterans, active military, and some surviving spouses. If you qualify for a VA loan, you've basically won the mortgage lottery. These loans require 0 down payment, and I mean 0. Not 0, but actually 3% in disguise. You also don't pay mortgage insurance, and the credit score requirements are more flexible. VA loans are backed by the Department of Veterans Affairs, which means lenders are more willing to take risks because Uncle Sam is covering their backs. It's like having a really reliable friend co-sign your loan, except that friend is the federal government. The only downside is you pay a funding fee, which is typically between 2 and 3% of the loan amount. But here's the thing, you can roll this fee into your loan so you don't have to pay it up front. And if you have a service-connected disability, the funding fee is waived entirely. USDA loans are for rural and suburban areas, and yes, USDA stands for the same department that inspects your chicken nuggets. These loans are designed to help people buy homes in less populated areas, and like VA loans, they require 0 down payment. The catch with USDA loans is location. Your house has to be in what USDA considers a rural area. Though their definition of rural might surprise you. Some suburbs that feel pretty developed still qualify. It's worth checking the USDA eligibility map because you might be surprised what counts as rural. You'll also need to meet income limits based on your area's median income. USDA doesn't want to help wealthy people buy vacation homes in the countryside because these loans are designed for moderate income families. Now, let's talk about income and employment verification because lenders are going to want to know that you can actually afford to pay them back. Shocking, I know. For employment verification, lenders typically want to see 2 years of stable employment history. This doesn't mean you have to work at the same job for 2 years. It means that you need to show consistent work in the same field or career path. If you're switching jobs right now before buying a house, don't panic. If you're staying in the same field and getting a raise, that's actually a good thing. If you're switching from being a teacher to becoming a professional juggler, that might require some explanation. Self-employed borrowers face additional scrutiny because your income can be harder to verify. Lenders typically want to see 2 years of tax returns and profit and loss statements. If you've been self-employed for less than 2 years, you might need to wait or find specialized loan programs. For income calculation, lenders look at your gross monthly pay. That's before taxes, not your take-home pay. They'll verify this with pay stubs, tax returns, and employment verification forms. Now, here's where it gets interesting. Debt to income ratios. Lenders calculate 2 ratios, front end and back end. Front end ratio is your proposed housing payment divided by your gross monthly income. Most lenders want this to be 28% or less, though some loan programs allow higher ratios. Back end ratio is all your monthly debt payments, including the new mortgage, divided by your gross monthly income. This typically needs to be 43% or less for most conventional loans, though some loan programs allow up to 50%. Here's an example. If you make $6,000 gross per month, your maximum housing payment would be about $1,680 using the 28% rule. And your total debt payments couldn't exceed $2,580 using the 43% rule. The key to remember is these ratios include everything: credit card minimum payments, car loans, student loans, child support, alimony, and any other recurring monthly debt obligations. It's like a financial physical exam where they check everything, not just the parts you want them to see. Down payment options and programs. All right, let's talk about the question that keeps most first-time homebuyers awake at night. How much do I actually need for the down payment? For decades, people believed you needed 20% to buy a house, which on a $300,000 home is $60,000. If you're sitting there thinking, $60,000? I don't have $60,000. Don't worry, that 20% rule is more myth than reality for most first-time homebuyers. Here's the truth. The median down payment for first-time homebuyers is actually around 6%. That's right, 6%, not 20. On that same $300,000 house, 6% is $18,000, which is still a lot of money, but it's not the sell your firstborn child kind of money. Let's break down your down payment options by loan type because this is where things get interesting. With conventional loans, you can put down as little as 3% if you're a first-time buyer or 5% if you're a repeat buyer. Some lenders even offer 1% down programs, though these are less common and usually come with higher interest rates or additional requirements. FHA loans require 3.5% down, and this option is available to anyone, not just first-time buyers. It's like the Democratic option of down payments. Everyone's welcome. VA loans, as we mentioned, require 0 down payment. Zilch, nada. If you're eligible for a VA loan and you're not using it, you're basically leaving free money on the table. USDA loans also require 0 down payment, assuming you meet the location and income requirements. It's like getting a free upgrade to first class, except the upgrade is home ownership. Now, here's where it gets really interesting. First-time homebuyer assistance programs. These exist at the federal, state, and local levels, and many people don't even know they exist. It's like finding out there's been free pizza in the break room all along, but nobody told you. These programs come in several flavors. Some offer down payment assistance in the form of grants. That's free money you don't have to pay back. Others offer low-interest loans for your down payment, which you do have to pay back, but often without interest or with very low interest rates. Some programs offer closing cost assistance, tax credits, or reduced interest rates on your mortgage. The eligibility requirements vary widely, but they're typically based on income limits, first-time homebuyer status, and sometimes occupation. Say teachers, firefighters, police officers, and healthcare workers often get special programs. The best way to find these programs is to search for first-time homebuyer programs plus your state or city name. Most states have housing finance agencies that administer these programs, and many cities and counties have their own programs too. Here's the thing about these programs. They often have limited funding and work on first-come, first-served basis. It's like concert tickets for a really popular band, except instead of getting to see your favorite artist, you get help buying a house. Now, let's talk about gifts from family because many first-time homebuyers get help from the bank of mom and dad, and most loan programs allow gifts for down payments, but there are some rules. The gift has to truly be a gift, not a loan. Your parents can't give you money for a down payment and expect you to pay them back, at least not officially. The lender will require a gift letter stating that the money is a gift with no expectation of repayment. The gift giver typically needs to provide documentation showing where the money came from, bank statements, sale of assets, whatever proves they're not laundering money through your home purchase. Different loan programs have different rules about gift funds. Conventional loans typically require you to contribute at least some of your own money if you're putting down less than 20%. FHA loans allow the entire down payment to come from gifts. VA and USDA loans allow full gift giving. Some loan programs also allow sweat equity to count towards your down payment. That means if you're buying a fixer-upper and you're going to do work on it yourself, the value of that work can sometimes count as part of your down payment. It's like getting credit for your future Pinterest projects. Now, let's calculate your total cash needed because the down payment is just the beginning. You've also got closing costs, which typically run 2 to 5% of the loan amount. On a $300,000 house, that's $6,000 to $15,000. You might need money for inspections, appraisals, and moving expenses. If you're buying a house that needs immediate repairs or doesn't come with appliances, you'll need money for that too. A good rule of thumb is to plan for your down payment plus closing costs, plus another $2,000 to $3,000 for unexpected expenses and immediate needs. It's like packing for a trip. You think you know what you'll need, but there's always something you didn't think of. Here's a pro tip. Some sellers will pay for part or all of your closing costs as part of the negotiation. This is called seller concessions, and it can significantly reduce the amount of cash you need to bring to closing. It's like getting the seller to pick up the tab for dinner, except the dinner costs several $1,000s. The key is to understand all your options and plan accordingly. You might not need as much money as you think, but you want to make sure you have enough to close on the house and still have some money left over for things like, food and electricity. Understanding PMI and how to avoid it. Now let's talk about PMI, which stands for Private Mortgage Insurance, not please make it stop, although that's probably what you'll be thinking once you understand what it is. PMI is insurance that protects the lender if you default on your loan. Notice I said it protects the lender, not you. You pay for insurance that helps the bank, not you. It's like paying for your ex's therapy. You're footing the bill for someone else's peace of mind. Here's how PMI works. If you put down less than 20% on a conventional loan, you'll pay PMI until you reach 20% equity in your home. PMI typically costs between 0.3 and 1.5% of your loan amount annually, depending on your credit score, down payment, and loan terms. On a $300,000 loan, PMI could cost anywhere from $75 to $375 per month. That's real money that could be going towards your mortgage principal, your savings account, or that expensive coffee habit you're not giving up. PMI is calculated based on your loan to value ratio, or LTV. If you put down 10%, your LTV is 90%, meaning you owe 90% of the home's value. The higher your LTV, the higher your PMI cost because you represent more risk to the lender. Your credit score also affects your PMI rate. Better credit scores get lower PMI rates because lenders think you're less likely to default. It's like insurance for bad drivers costing more than insurance for good drivers, except this affects your housing costs for years. Now, when can you get rid of PMI? There are several ways, and understanding these could save you hundreds of dollars per month. First, automatic termination. Federal law requires lenders to automatically cancel PMI when your loan balances reach 78% of the original home value, assuming you're current on payments. This happens naturally as you pay down the mortgage, but it could take years. Second, you can request PMI removal when your loan balance reaches 80% of the original home value. You typically need to pay for a new appraisal to prove the home's value, but if the appraisal comes in at or above the original purchase price, you can get PMI removed. Third, if your home has appreciated in value, you might be able to get PMI removed based on current market value rather than the original purchase price. If you bought your house for $300,000 and it's now worth $350,000, you might have enough equity to remove PMI even if you haven't paid down much of the loan balance. Some lenders allow this after 2 years, others require 5 years or more. It varies by lender and loan program, so ask about specific requirements when you're shopping for loans. Now, let's talk about strategies to avoid PMI altogether, because paying for insurance that doesn't benefit you is like buying lottery tickets. It might work out, but the odds aren't in your favor. Strategy number 1, put down 20%. I know, easier said than done, but if you can swing it, putting down 20% eliminates PMI entirely and usually gets you a better interest rate too. Strategy 2, piggyback loans, also called 80-10-10 or 80-15-5 loans. This is where you get a first mortgage for 80% of the home's value, a second mortgage for 10 or 15%, and put down 5 or 10% yourself. The idea is to avoid PMI by keeping the first mortgage at 80% LTV. Piggyback loans used to be very popular, but they're less common now because the math often doesn't work out. The second mortgage company typically has a higher interest rate than PMI would cost, so you're not necessarily saving money. Strategy 3, lender-paid PMI insurance, or LPMI. With this option, the lender pays your PMI in exchange for a slightly higher interest rate. The advantage is you don't have a separate PMI payment, and the higher interest rate is tax deductible while PMI might not be. The downside is that you can't remove LPMI like you can regular PMI. It's built into your interest rate for the life of the loan unless you refinance. Strategy 4, VA loans if you're eligible. No PMI, no questions asked. It's like having a VIP pass that gets you out of paying cover charges. Now, let's compare PMI costs versus larger down payments, because this is where the math gets interesting. Let's say you're buying a $300,000 house. If you put down 5%, that's $15,000, and you'll pay PMI on a $285,000 loan. If you put down 10%, that's $30,000, you'll pay PMI on a $270,000 loan. The PMI will be slightly lower because your LTV is better, but you'll still pay it. If you put down 20%, that's $60,000, but no PMI at all. The question is it better to put down the extra money to avoid PMI or invest that money elsewhere and pay the PMI? This depends on several factors. What return you can get on the invested money, how long you plan to stay in the house, your tax situation, and your personal comfort level with debt. If you can invest the extra money and earn a higher rate of return than the PMI costs you, it might make sense to pay PMI and invest the difference. But if you hate the idea of paying for insurance that doesn't benefit you, or if you don't have good investment options, putting down more money to avoid PMI might be the right choice. Here's a simple way to think about it. PMI typically costs about 0.5% to 1% of your loan amount annually. If you can reliably earn more than that on investments after taxes, it might make sense to pay PMI and invest the money instead. But remember, investments carry risk, while PMI is a guaranteed cost. You might earn 8% on your investments this year, or you might lose 20%. PMI will definitely cost you whatever the rate is. The bottom line is PMI isn't the end of the world, but it's not fun either. Understand your options, run the numbers, and make the choice that makes the most sense for your situation. And remember, PMI isn't permanent. You can get rid of it eventually, either by paying down the loan or by home appreciation. Wrap up. Congratulations, you've just mastered mortgage fundamentals, which puts you ahead of probably half the people who actually have mortgages. You now understand the difference between the loan types better than some loan officers. You know exactly how much you need for a down payment without believing the 20% myth, and you can explain PMI at dinner parties, assuming you want to be that person at dinner parties. Here's your homework before Module 3. First, figure out which loan type makes the most sense for your situation. If you're a veteran, look into VA loans. If you're buying in a rural area, check out USDA. If you're a first-time home buyer with less than perfect credit, FHA might be your best friend. Second, research first-time home buyer programs in your area. Seriously, do this. There might be free money available to you that you don't know about, and free money is the best kind of money. Third, calculate how much cash you actually need, including down payment, closing costs, and a little extra for surprises, and start saving if you're not there yet. Remember, the mortgage world might seem complicated, but it's really just a bunch of different ways to borrow money to buy a house. Some ways are better for some people, some ways are better for others, but they all end with you getting the keys to your own home. In Module 3, we're going to talk about getting pre-approved, which is where all this knowledge turns into actual action. We'll cover finding the right lender, navigating the pre-approval process, and understanding the mysterious 60-day look-back period that strikes fear into the hearts of home buyers everywhere. So I'll see you there.